So too clever by half. What we see over and over again are strategies for investment that believe they can outperform the market for a sustainable period of time. But a static strategy assumes a stability and a predictability that simply doesn't exist in the market. As we've seen, the market is fundamentally irrational. As Benjamin Graham pointed out, Mr. Market is a bipolar schizophrenic who is ebullient one day, depressed the next day, and trying to predict with some rationality what those movements will be is sort of a fool's errand. And the other thing we've seen about the lack of predictability, of course, we have these extraneous events that we just really can't see coming, like the pandemic, and of course the tragedy in Ukraine are recent examples. But we know that something's going to happen that's going to impact a fundamental strategy. And thinking that one can outwit that on a sustainable basis is, again, sort of a foolish approach to investing. And so one of the things that we can be certain about is uncertainty, right? So an investment strategy has to take this into account. So there will be uncertainty, there will be movements, there will be things that will happen. And so how do we understand that? And then more importantly, how can we profit from that? And of course, the irrationality when we see things that are just way overvalued and you scratch your head going, well, I'm not going to be the greater fool, but many of these strategies are based on those greater fools, right? So what we've seen hedge fund blowups these days are really centered around these growth strategies, right? That it was a belief for a long time in a very simplistic approach to an investment. Well, what is the revenue growth? We see high revenue growth. We see these transformational businesses. They'll keep growing. They'll keep creating value. And there are examples of that, right? But the examples are one or two. They are not 30 or 40. They are not a portfolio of an ETF, right? And so a precision and an understanding and a little bit of luck is required for those extraordinary returns. But a business strategy that uses it as its fundamental core investment strategy, is bound to fail. And we've seen that over and over again. So any long-term success has to focus on risk management, has to focus on understanding these uncertainties, and then understanding how to manage for them and also to profit from them. So one of the things that I talk about is, well, we have to kind of debate gravity over and over again. And one of the challenges, and Nassim Taleb really pointed this out in the quote that says, the one thing that he came to understand about economics is that economists really don't get anything right. And fundamentally, that's what's going on with a lot of these investment strategies. Now, these investment strategies can work for a little while. And so in an environment where you've got stability, in an environment where you can understand the inputs, you can do well. But those change, and we've seen the market is irrational, the market is unpredictable, and those things will occur that will undermine those assumptions and therefore impact your performance. And so we've seen that, especially now with, I'll call them the flavor of the month, which are these growth strategies. So we're going to have superior growth, which will generate superior return. So we'll leverage that and get even more superior return. Well, that's fantastic till it doesn't work anymore and then you explode, right? We've seen examples of hedge funds going out of business based on that one strategy. Perhaps the most recent example, when you look at just the devaluation in the ETF ARC, right, which focused on high growth transformational businesses. Okay, great, that can work for a little while, but things change. And suddenly that growth percentage, which sounded great, started from a very low base. Those companies really don't make any money and they probably won't. And so you've got an ETF with 40, 50, maybe 80 names in it. Well, one or two may do well. And you don't know which one or two, but 80 won't. And so ultimately you can't defy gravity. It comes back, it reverts to the mean. These kinds of businesses are very risky. Few ever are profitable. So that strategy over the long term is bound to lose. And that's the other fundamental problem here, which is a static model assumes stable inputs and a stable market. And that's really never the case. And so when we think about, so one of the things that we hear over and over again, other than defying gravity, which won't occur, is that it's different this time. And that's another thing. It's not different this time, and it's never different this time. We've got examples, very famously, long-term capital management with Nobel Prize winners had a strategy that outperformed the market spectacularly for several years. They leveraged up, they assumed a constant state of inputs, a stable market, and then they blew up, right? And they almost took the financial system down with them, right? And Also, we have an example of great success, which is in James Simon's Renaissance Technologies, where fundamentally they assume there's going to be a lot of dynamic changes in the market. We'll develop a system that responds and tries to predict those dynamic changes and profit from that. So we really don't care so much about the point-to-point price because it can even be flat. But one of the things we know, we're in a very volatile, and that volatility is going to be more frequent, more intense, and there are ways to profit from that. But it is not different. So we have, those growth strategies that really last for a little while, but then end drastically. One of the things, if we back up and we talked about the failure of economics, so let's go back to the person who really innovated the algorithmic approach to economics, which was Paul Samuelson at MIT. So Paul developed this understanding that, well, we can look back historically. We can see what factors influenced the market, what factors influenced the economy, and then we can manage and predict if we have those factors, this is what the economy will do, right? And so once again, that can work for a little while, but those factors are always dynamic. Those factors always change. And that approach to economic prediction has turned out to be, spectacularly wrong when it really mattered, right? And that's, again, the fundamental point here is when you've got a stable market, you have a normal distribution, you can make predictions within that. And that also gets to the financial crisis of 2008, where they focused on value at risk, right? So the value at risk was what was within that normal distribution. Well, when things go wrong, that value at risk goes to the edges, and that's beyond the normal distribution, beyond the predictable models, and then you have these disastrous results. So that is one of the problems that's driving this assumption that, well, we can figure out something that's happening, we can manage and model that, and we don't have to worry about risk. Well, that's so fundamentally wrong, right? Because the one thing that I'm emphasizing here is uncertainty is certain, right? And rationality and predictability only works when the market is stable. And the one thing we can count on is the market will not be stable. We don't know when it will be unstable. All we know is that it's going to happen, right? And so knowing that it's going to happen, we have to think about, well, how do we manage this? And go back to John Maynard Keynes. Like in 1921, he published a paper that talked about the irrationality of markets. And markets will have dramatic movements, and they really can't be predicted. They must be prepared. You must be able to withstand that kind of volatility, and you can even profit from that volatility. Right? So that was 1921. But then we had the crash. We had financial crises maybe every 7 to 10 years now, which seems like a regular event. And now we have Nassim Taleb coming along saying, hey, by the way, there were these black swans, right? Okay, so 100 years later, we haven't learned that lesson yet. And so understanding that uncertainty is certain is something that needs to be repeated apparently over and over again. All right, so to summarize here, we're saying that incorporate uncertainty and irrationality and understanding that there will be frequent and intense volatility, and there are unforeseen events, and there'll continue to be unforeseen events. So the issue is that market forecasts rarely get anything right, and usually when there's a strategy based on those forecasts, they fail spectacularly, and profits are really found at the edges, right? At the edges of the extremes, up and down. And understanding when those extremes are coming and profiting from them is a more fundamental strategy. But in order to be sustainable within that strategy, you have to account for risk. So uncertainty that there will be failures, there will be movements that are unpredictable. So risk management, more than anything, is the most important component to a sustainable competitive advantage for an investment strategy. And then understanding that uncertainty, that volatility, the unpredictability, and the irrationality that takes market conditions, impact market conditions always, these are the things we need to take into account.